Welcome back and Happy New Year. It's been an interesting start of the year so far. We've seen a lot of the momentum at the end of 2023 reverse in this first week of the year. So in today's video, we are going to be looking at some of the momentum, but we're going to be focusing basically on the US CPI data released later on this week, and of course, how the US dollar has been performing. Hello and welcome back to our channel. My name is Daniela. And as I said, in today's video, it is going to be focused on US CPI and the US dollar. We will review a little bit of the momentum that's happened in the week prior, so the first week of 2024. But of course, before we get into this video, please like, subscribe, comment, and turn on your notifications. And if you have any questions about trading or the markets in general, feel free to put them in the comment section down below and we'll try and get back to you as quickly as possible. So as I was saying, the momentum to the start of the new year has been pretty interesting. It seemed like the first trading day back from New Year's, we were following in the same momentum that we'd seen prior towards the end of 2023. But that quickly reversed, and we've actually seen a lot of that go in the opposite direction. We've seen the dollar higher, we've seen equities pulling back, we've seen gold and silver struggling to find momentum to continue to push higher. And we have seen some events or data points come out that have steered some of that momentum. But it really just seems like markets were a little bit overextended. We knew this ending last year. We knew that was happening. If we look at equity markets and the track record they had in the last quarter of the year, it was just continuing to push higher and higher, even though we did have that technical overbought levels being pushed and being tested continuously. The US dollar and US yields were being sold off heavily, and that was, of course, discounting the fact that the Federal Reserve would start cutting rates soon and would do it at a pretty fast speed, at least at what markets were anticipating. Of course, the FOMC meeting at the end of December really pushing that in favor of those dovish hopefuls. We saw how admitting that the end of rate hikes had come and pretty much all but promising rate cuts early this year. So that was how we ended the momentum. This year, we have seen a turn, as I've said. I think there's been a lot of discounting of easing monetary policy that's happened already. We've come to that point where it's really an indecision period. You know, when is the cutting going to start? How far is it going to go? There seems to be a lot of disjointment right now between the Federal Reserve and what markets are anticipating. And of course, that is creating a lot of uncertainty. But before we go into that, let's quickly review what happened last week. Because on Friday, we did see the US jobs data and the US services ISM data coming out. Now, the jobs data surprised to the upside. We saw stronger NFP. We saw the unemployment rate not rise as markets were anticipating. So again, stronger than expected. We also saw average hourly earnings ticking up. So in general, we saw a stronger reading for the US labor market. But one thing to point out is the participation rate that actually came down. And essentially what that means is there's a smaller pool of people looking for employment, and therefore if there's less available workers, it puts more pressure on employers to compete on salary basis. And that essentially means further domestic and wage inflation further down the line. So even though we did see that the economy remains resilient, especially in the jobs market, the fact that we have seen the participation rate come down has set off some warning bells. And essentially, as I said, expecting to put further pressure on wages down the line. And of course, that can have an effect on the monetary policy. So at first, we saw a positive reaction in the dollar and US yields. We saw them shoot higher as the labor market came out, the labor data come out, especially, as I said, focusing on that headline reading, stronger than expected jobs added in December. Earnings once again higher, the unemployment rate remaining unchanged, and all of that fed into that positive dollar, pushing back expectations of immediate cuts from the Federal Reserve. But we saw a 180 turn in momentum. We saw the dollar reversing those gains and seeing some weakness, and also US yields also coming down lower. As we saw the US services ISM data coming out worse than expected, the lowest reading since May. And it does services do account for 2/3 of the US economy. So that once again, bringing in that doubt about recession, those concerns about growth in the economy. And even though we did see outstanding growth in GDP in the third quarter, in the US, much better than European economies, much better than the UK, there is still doubt about how well the economy is going to hold, especially if the Federal Reserve continues to hold monetary policy at these restrictive levels for long. That is essentially what we got from the Federal Reserve's meeting in December, those concerns about restrictive policy being too restrictive for too long. Markets, of course, have been playing into that for a while. That's why we've seen that rally in equity markets, because we saw that worsening data feeding that sensation that the Federal Reserve was going to, realize that it was going too far, that cuts were going to come. But of course, this stronger jobs data and that lower participation rate, those concerns about domestic inflation, wage inflation, once again, putting a spanner in the work of these dovish perceptions. And once again, bringing in those questions of, when are we actually going to see that first rate cut? And when we do, what is the speed of those rate cuts? And of course, the answer to those two questions is what's going to drive markets, especially in the first quarter of this year, as more and more data comes out and more expectations form. Now, in terms of this week, as I said, the big event is going to be the US CPI data. We will have some FOMC members speaking, and we have Fed Bostic speaking this afternoon. But I think we are going to be in a little bit of a technical trading from here until then. I think we're going to see some consolidation until we get to that big release on Thursday. Of course, if we have any significant commentary come out that skews those perceptions, then we may see some momentum. But I think there's a little bit of a lack of conviction, and I think markets just want to know more at this point, because is the stronger US jobs data an outlier? Is it essentially really feeding into that stronger economy, and whether that's going to drag on those expectations about rate cuts further? So right now, markets are pricing in around a 60% chance of a cut in March. That would be the second meeting of the year. We have one at the end of January. No change expected there. Expecting to see the first one in March. Market currently pricing in around 6 rate cuts in 2024. As we know from the Fed and from the FOMC meeting minutes, they're pricing in around 3. So as I said, there is a big disjointment there. And of course, CPI data, like the one released on Thursday, can really skew that. Markets' expectations are to see a slight uptick in inflation in headline CPI. That's not uncommon. We've seen it elsewhere. We saw the Eurozone CPI last week, and that showed a rise in inflation in December as well. Headline CPI expected to rise from 3.1 to 3.2 in December. Not a massive increase, but of course, just once again evidencing that the disinflation process isn't linear, that just because we've had 3, 4, 5 months of dropping inflation doesn't mean that that is the trend, a solid trend that's going to continue until we hit that 2% target. And as we all know, the disinflation process gets harder and harder the closer you get to the target. And that's why inflation is expected to drop at a slower pace this year. And as I said, that can skew those expectations about monetary policy. So as I said, CPI expected to rise slightly to 3.2%. Core inflation continuing that downward trend from 4% to 3.8%. Now, how the actual data comes in line with its expectations, that is what's really going to drive that momentum this week. If we do see a stronger than expected reading, I wouldn't be surprised if we see the US dollar, US yield really pushing higher once again, breaking that resistance that we saw on Friday. Equity markets, of course, coming down on the back of that alongside gold and these more rate-sensitive commodities. If we see a weaker than expected reading, the opposite will happen, of course. If it comes in line with expectations, well, that's really where you have to read within the lines. We've seen the labor market showing, a resilient economy overall, but we do have some pockets of weakness, as we've seen with the ISM services data. So there's a lot of reading into that. Maybe some consolidation, expecting to see some further information. Of course, the Federal Reserve meeting at the end of this month is going to be key to that as well. How will Powell and his team view this latest data, and how do they see monetary policy adapting over the next 12 months? But there is a lot of momentum to be had this week, later on in the week. As I said, a little bit of a technical trading in the first few days, looking ahead to that CPI. Let's jump onto the charts now to have a quick review of the US dollar. So let's kick it off with the US dollar index, Capital.com via TradingView. As you can see here on Friday's session, ending the day pretty much unchanged from the open. As I said, that strong move higher once we saw that stronger jobs data, and then coming back and undoing that, seeing that tail as well as we saw the services sector showing that weakness. So far today, struggling to find any direction. As I said, likely to be technical trading, likely to see some sideways consolidation. There isn't that much on the calendar affecting the US dollar from here until Thursday. So expected to see a little bit of a lack of direction. If you can see here, the RSI just skimming below that 50 line, that midline. So again, trying to build that appetite to push higher. I think from Friday's session, we can see the appetite is there. It's just a lack of conviction as to how far this can go. We know markets have discounted a lot of the monetary policy cuts in the last quarter of 2023. So in a way, there is potentially a ceiling as to how far equity markets can go, and a low as to how far the dollar can drop in the next few weeks, considering so much momentum has been priced in already. So on the bright side, it looks like we could continue to push higher. Fundamentally, there is reasoning to do so. And considering we have seen inflation pick up across Europe, we could see potentially a stronger reading than expected in the US, and that would propel the dollar higher. If that is the case, I wouldn't be surprised if we break 103. That would be the first time since before that FOMC meeting in December that really showed that dovish tilt. And a lot of that could come on the back of that weakness in the likes of Eurodollar and cable. Now, another thing to watch out for is the fixed income market. This down here, this solid line, this is the US 10-year yield. As you can see here on Friday as well, picking up that momentum on the back of the stronger data, jobs data, tilting to the downside to end the session as we saw that services sector data. But we have seen some interesting recovery in that first week of the year, that strength in the US dollar and strength in the conviction that maybe the Fed is not going to be as dovish as everyone has expected, has allowed US yields to pick up. And of course, that has weighed in gold, as you can see here, seeing that weakness portrayed in today's session. We know when US yields are picking up, we see gold trending lower. So one to watch out for as well this week will be gold and commodities on the back of that. And of course, equities, we've seen a little bit of a retracement. If we pull up the likes of the Russell 2000, for example, one of the most economically sensitive in the US majors. You can see here on Friday, on the last week, on Wednesdays here, we saw that pullback. And of course, as we've seen more expectations shifting towards less likelihood of rate cuts, we have seen the Russell 2000 really pulling back here, struggling to find that momentum to push higher past that key resistance in 2023, as markets are now not so convinced that the Fed is going to be so dovish. That is it for today's preview of the US CPI data released on Thursday. Thank you so much for watching, and don't forget to subscribe to our channel.